So good morning, everybody. We're just sort of letting everybody get in and sign up and sort of just get settled for the day. If everybody can remain on mute, please, just for now. We are recording, so this will be recorded, put out on public for people to see. So if you don't want to be seen, keep your videos off. If you don't really want to be involved in the conversation publicly, in a sense, then you know, obviously we can always chat afterwards. But yeah, if you can all just remain on mute for now, that would be absolutely great. Hopefully everybody can see and hear us okay. Right then, should we give it just give it a minute or so, make sure that we've given people a chance to log in, and I'll keep an eye on it and keep letting people in as well. Do you want to start, Lee? We'll start getting into it all.
Yeah, perfect. So welcome everybody to the second in the series. Today, as you know, it's about IHT gifts and all things around that. You're not really here to listen to me at all. You're here to listen to Catherine. So welcome. Thanks for attending. As ever, feel free to ask questions in the chat or later if we have a bit of an open chat, if we have time for an open chat. But thanks for coming along. Just a reminder, if everybody could be on mute whilst we get started. So over to you, Catherine.
Okay, thank you, Lee. So thank you everybody for coming. We are going to be talking about protection insurance and the IHT and gift planning side of things. So I think it's really important from the start for me to always be very clear that I'm a protection insurance advisor. So I'm not here to discuss IHT and gift calculations or anything like that. I can do very, very basic aspects of it in terms of if I'm speaking to somebody, but I will always speak to an IFA if we do have someone in that kind of a situation, just to make sure that there's no kind of magic in the background. Because I know sometimes IHT, you know, and things like that, advisors can sometimes do things that are weird and wonderful that us mere protection insurance advisors would have no concept as to what you're doing. So I'm just purely here on the insurance side. So when we are talking about things like the IHT and gift planning, so lots of people be aware that there is a 40% tax at the moment. So when we talk about this is obviously beginning of 2024, we're chatting. So at the current time, it's about 40% tax that can be there for people and for their families if they are to die, and certain time frames and things like that. But if we look at the IHT side of things first, just can hear a little bit of noise there. I think I know who that was. It was someone who works with me and has got a little one at home that's not very well. Anyway, so we're going to be looking at the IHT first, then we'll move on to gift, and then I'm going to slightly go on to business property relief insurance. I'm not going to do that too in depth. It is quite technical and there's only so much that I can chat through in 45 minutes. I am a fast talker, but there's still limits to what I can do at times. So when we're looking at people, generally, if we're looking at from a very basic point of view, everybody has a certain amount of assets that they're allowed to give someone that they can inherit without them being taxed. And that is usually the nil rate band that we're referring to. And for a single person, that is £325,000, and anything above that can potentially be subject to inheritance tax. We then also have the fact that they can sometimes have a bit extra in terms of what's known as their residence band that can be added onto it as well, which is up to £175,000 on their main residence. So a single person can potentially have about £500,000 of assets that someone can inherit off them without there being any kind of inheritance tax there. Now, if we have a married couple, there's no inheritance tax between married couples. So if we don't, in a sense, use that inheritance, in a sense of one person does die, that 325,000, that 500,000 can just be absorbed and added on to the surviving partners, which can mean, you know, potentially that we have £1 million worth of assets between a married couple before IHT might be coming into play. So and as joint couple, so basic, in a sense, between a joint couple is 650,000. We might have that extra there in terms of the main residence as well. It can be a bit tricky depending upon how the residence has been owned, whether or not there's been any kind of use of IHT in the background. So what I would say is if you are a protection insurance advisor, it is always a good idea to sort of like chat to people and say, if you think someone's near this level, or if they are definitely in this level, make sure that they do have a financial advisor and that they can at least reach out to somebody that you suggest, that you trust, who can have a look at it, make sure that everything's being done in the best way possible. Because sometimes with these things, there are stuff that financial advisors that can do that will obviously lessen it quite a bit. So when we're looking at protection insurance for inheritance tax, what we're really wanting to do for a married couple would be what's known as joint life second death. And that basically means that the insurance is going to cover both people. And what will happen is that they will, sorry, it's just thrown me then. Lee just suddenly left it. It's just suddenly confused me. I think he's done it so that I'm the main feature here, so that's fine. It just sort of changed my vision a little bit with it. Hopefully he's not lost signal or connection. We'll be doing joint life side. So it insures both people. If someone dies, the policy still continues, and then it'll pay out on that second person's death when the actual IHT will be due. Because the IHT itself, this is different to gift planning, but the IHT itself for a married couple will be due on the second death. So it's actually cheaper as well. So joint life first death, if we're looking at it, in a sense, the risk for the insurer, the gamble, is basically that, in a sense, one of them dies. But with joint life second death, the risk of the gamble is that both of them die. And it's actually really, really low risk that you would die at a young age, in a sense, or that you die before what we would be expecting, in a sense. Obviously, it can happen. It does happen a lot, but the risk is quite low. And there are times as well where, so I've been helping some people recently where there is somebody who, well, there's a couple, and one of them maybe has a risk. So often we're thinking health risks. Sometimes though, with people who are high net worth, I have to say, you do come across quite a few who do tend to go skiing quite a bit, who maybe like to go sailing and things like that. And depending upon what they're doing, that can quickly lead into, potentially quite large risk ratings. And when we're talking, especially if it's about sport, it's what's known as a per mil rating. Now, I'm sure quite a lot of people will be familiar with that, but just in case, when we see increases on premiums with insurances, a lot of the time it's a percentage increase. So we're probably all familiar with plus 100, which basically means the insurer is going to double the premium because they think there's double the risk of this person making a claim, roughly. I'm probably making that fair. I'm sure some underwriters will tell me off for saying it in such a basic term. With per mil ratings, it's very different. Per mil is an extra payment that the person has to pay for every £1,000 of cover that's taken out. So when we're talking a lot of the time about IHT liability, we're usually talking about people who are quite high net worth and where the IHT liability is quite significant. So for each of those £1,000, it gets quite a lot. So we just need to be really, really mindful of that. However, there is, especially with doing joint life second death, there's a little bit of a technicality with it. And it's not really technicality, but it's a little bit of an interesting thing with it when it comes to risks. Because obviously they're gambling on two people dying. And forgive me for being blunt about it. It's just sometimes it's easier to sort of explain what we're trying to do. So if one of those people has quite a risk, maybe it's a sport risk, maybe it's a health risk, and you might be thinking, well, they're going to be declined, based upon my experience. That's not necessarily the case, because the insurer, obviously, they're gambling on two people dying. So this person here has a lot of risk. So they kind of class them as, well, they'll just be the first one that goes. So the other person's still there. So the person can still be really insured. And what's quite interesting about that is that you could do joint life second death. The insurer might go, right, we're insuring this person here, but ultimately, we're sort of like saying that we couldn't insure them, but because we kind of expect them to go first, then they can be included in it. But the second person that they assume is going to be absolutely fine, live until, 90s, later on, there might be something happen, which means that they actually do die quite early. So the one that they think is riskier still has the insurance then. So it is a really good way, actually, of insuring people that might not be able to be insured otherwise. If you do find, though, that somebody is, I'm going very technical, so forgive me if I'm sort of jumping around the place a little bit. If you do find you've got two people and one of them has really got high risk and this person would really be a decline, And then what would happen is that the insurer would insure both people, but they'd price for a single life. So just be conscious of that when you are doing your premium calculations, because again, if we're talking IHT, usually not the cheapest of premiums, and we want to be mindful of that. So joint life second death is actually cheaper than joint life second death, but one person's been declined and they're only pricing for one person. It's quite complicated, but them's the rules kind of thing. And we just want to be very, very mindful of that when we're chatting about it. Ideally, inheritance tax, we're going to be doing joint life second death whole of life insurance. There's different types that we can do. I'm sure everybody has their own view as to what's best and things like that. I speak to quite a lot of people who come to me through IFA connections who want me to support them. And they've set up whole of life insurance donkeys ago, 20, 30 years ago. And they've got that rate reviewing because it was whole of life reviewable insurance, which I have to say looks incredibly lovely, really, really lovely from the start. It's, you know, I can give some examples of some pricing I've done recently for somebody. So the reviewable option will look brilliant and the person is going to want that. The problem is that when you start to get towards the age of 60s, 70s, and these reviewable ones start to review generally on a 5-yearly basis, the premiums start to significantly go up. We're not talking small amounts. We're talking easily doubling. You know, they've been paying £250. They're now being told it's going to be £600. And they're now saying, whoa, that's ridiculous. That's such an increase. I don't want to do this anymore. I want something where it's never going to change. And the problem is that a lot of the time at that point, it might be a case of, well, your reviewable premium is £600. But to lock it in place now, you need to pay £1,100 to get a guaranteed premium, which obviously, in many ways, who wants to go for that? But then in the long-term thing of it, you think, well, actually, that is a huge jump, 600 versus like £1,100. But this £600 probably going to at least become £1,200 in 5 years' time. And then 5 years' time from that, we're going to be probably over 2,000. You know, I mean, I am obviously making numbers up here, but it's very significant increases to the point that people will just start cancelling the policy. They just literally cannot afford them anymore. So when you are looking at these options, it is a good idea to give people the guaranteed and the reviewable option, but it's important to really discuss it with them. And people, you've got to give them the choice and let them choose what they feel is right for them. I have somebody I've been supporting recently. We needed to do some whole of life insurance. We're doing £200,000 of whole of life insurance. That was going to be, you know, assuming that they live a good old time, you know, it's going to be there for another 40 years or so. Now, to lock it in place now, and premium to never change over, you know, say good 30, 40 years, assuming that they obviously do live as long as we would expect them to, the premium for that was about £200 a month. And the reviewable premium was £16 per month. Huge difference. And obviously we went through that discussion. When you look at the reviewable ones, they will say in the illustrations, this is what we expect it to be in 10 years time, 15 and 20 years time. Problem is that obviously you can't see the projection beyond 20 years time. And also those projections are simply projections. There's no guarantee that they're going to increase at that rate. It might be more favorable, but it could also be much more expensive when we get there. So we want to be really, really conscious of that. So again, ideally, joint life, second death, whole of life insurance. Obviously, if someone is single, then we'll be just doing single life, whole of life insurance. That's absolutely fine too. But we can find as well that some people literally cannot afford the whole of life insurance premium, even if they've got all this net worth. And sometimes you can find people, obviously, who are high net worth, you know, that they are people as well, just going, I'm not paying for that kind of thing at times as well. Just, you know, sometimes I think people assume that because someone's high net worth, they will just kind of throw money at these things. They won't. They need to obviously see the value of them, just as the rest of us would do. You know, they don't always have lots and lots of cash spare to be able to spend on these things. So what can be an option? Now, this is one where you have to be careful with your recommendation in terms of what you're writing in your report to your clients and what you're suggesting to them is you would always give them the price for whole of life. But you could also potentially look at joint life second death insurance to age 90. So a term insurance policy. Not ideal. And I think we all need to agree from the start, it's not ideal to go to age 90. We want it to be whole of life if there's an inheritance tax liability there. But If it's a choice between somebody walking away with no insurance because the whole of life is too expensive, or going to age 90, which covers a significant risk time period of where they potentially will die, it's worth giving them that price and giving them that option to be able to decide if that feels right for them. To age 90 will be significantly cheaper than whole of life because the insurer's gambling that they will live past age 90. Whereas with whole of life, there's no gamble. Assuming that that person is truthful in the application, assuming that they keep up to date with the premiums, then that policy is paying out. So that's why it's so much more risky and so much more insurance costly for the insurer. What we really want to do as well is have a look at what's going to be happening with the beneficiaries and things like that. So there is some consideration to potentially saying to people, right, okay, well, it is, obviously, this is the price. This is to help usually children. So can the children help pay towards that price? They might not be able to. Some parents quite like that idea. Some don't like it at all, but it is a potential conversation that you can have, you know, sort of them going, oh, well, if it was half the price, I'd be able to do it. Just like, well, if you can do half, is there any chance that your kids can make up the other half? Because ultimately, yes, this premium may not be what you want it to be, but that liability isn't going anywhere unless the government does something really wonderful with taxation. And I say wonderful, I assume it would be wonderful for some, not wonderful for quite a lot of other people. But again, that's way outside of my expertise. So it is just something that you might want to be thinking about. In terms of the trusts, so really important with the trusts on these policies. Now, this can be debatable, but I can say what I will be doing in terms of my compliance. And just to go back just a second, so I said I would do this. So in terms of if I did term 90 for someone for IHT liability instead of whole of life, I would be very specific. I would have had phone conversations with the person that would have been recorded to prove that I've had this conversation. My demands and needs report would also be saying, I have recommended that you have this whole of life insurance and the cost was indicated to be this. You have, however, chosen to go with this option to age 90 because it feels much more affordable to you. And that is all about, obviously, we're protecting the client because we are giving them the insurance, we're doing everything we can. But we need to protect ourselves as advisors as well, protect ourselves from future complaint risks, any kind of uncertainty that we've not been clear with the client. So, you know, always go with like, this is what I recommended, but this is what's ended up going ahead. And when you are saying this is what I recommended, I do suggest including the premium in there as well, because again, it just removes, you've already got it there in front of you, and it just removes any kind of doubt in the future. If somebody is going to come back, maybe try and make a complaint, then when you say to them, but I put this in this document, it said this, it said the price, and you decided against it, then it becomes less and less likely that they're going to have that ability to potentially complain or say that there's been any kind of misadvice there, because you've laid it out very, very clearly for them. Right, going on to the trust side of things now. So when we get a trust, I did some wonderful planning for somebody with gifts. I'll explain that on the bit when we're going into the gift side of things. And it was an absolute nightmare. The trust, I'm sure you're all very familiar with trusts and how horrible they are. I am just talking about the trusts that are associated with life insurance here. I'm not talking about the financial trust that IFAs would be doing or could be doing, because I don't know anything about them. So in terms of that, we're going to be looking at the terminal illness benefit. Terminal illness comes with life insurance, basically says if you are ill and are diagnosed with less than 12 months left to live, we'll potentially pay out the claim early to you, you know, to help you financially during those last 12 months. Now, what we want to do is make sure that that terminal illness benefit is gifted to the trust, because if not, if they do go ahead with trying to claim on that terminal illness, which they might want to, they might not understand exactly what they're doing, they might just hear that they've been told they're terminally ill, they might just think, oh, this insurance says that, and go for it, then we've completely defeated the whole point of what we're doing. We have basically then the money from the payout is going to go into their estate, and then the inheritance tax is going to be even bigger than what we'd originally thought it was going to be. And that is a simple tick box that advisors we need to do. So it is something that you really, really should be on top of, making sure that you're going to getting that is going to be gifted into the trust. It's not always the case that we want to gift into the trust. For a lot of people, that isn't necessarily needed. But if you are speaking to people and it is an IHT plan, then we will be gifting into the trust with that. Do also watch out for automatic beneficiaries. Now, when we're looking at trusts, ideally we want to use something which is known as a what's it called? Not a nomination, but I'm just getting myself confused now. Discretionary trust. There we go. We do use discretionary trust, which basically allows the trustees to pay the money to who they feel is the best person. So usually when it's IHT, let's say we're going to have children, they're probably the trustees and their own beneficiaries. So it's very, very simple. Nicely done. But there are some insurers that when you do the trusts, it can be really, really tricky, because obviously it's when we're looking at these discretionary ones, because we also need to be able to hopefully change it, because maybe your child has died and we want to kind of like move it around a little bit. And with some of them though, it will say automatically this will pay out to your spouse. Now with inheritance tax, we don't want it to automatically pay out to the spouse. So with some insurers, we might need to choose a slightly different tax. And I did, that's when I'd gone to the gift thing, I had to use an absolute trust with one insurer, which is something that I would always want to avoid because it can't be changed. But without using it, it meant that it had to go to the spouse. And we had to avoid that because that just was not at all what we were wanting to happen to this. So keep an eye when you're doing the trust, what's happening to that terminal illness benefit, it is being gifted. And in terms of the beneficiaries, let's just make sure that there's nothing that will say that a spouse can potentially get it. Obviously, if it's terminal, if it's joint life second death, that's not necessarily an issue, but just really keep an eye on those beneficiary side of things. Okay. So when we are then, I was going to say as well, in terms of the IHT side of things as well, I'm not going to go into this too much again because we've only got a certain amount of time, but we do have something known as the Rice-Staff principle. Now, Andy Woolen from Zurich, some of you might or might not know him, he does brilliant training on gifting and IHT planning and a lot of these technicalities. If you do a search for him and Zurich, so Andy Woolen and Zurich on Google, you'll find, lots of information. Do put like Rice-Staff principle in, getting lots of information there and examples, which are really, really good. But essentially for a lot of people who are taking out term assurance, which is just a protection insurance policies, it's unlikely that the Rice-Staff principle would come into play. But if you do have somebody who's paying quite significant premiums on a policy, and it is potentially in the IHT level, so we are talking a really good amount of premium, you might need to be just really on top of that, really conscious of it. It could be that what you end up doing is, instead of doing one policy to cover the full IHT liability, you might be doing different, like smaller amounts, each of them having their own trust, and you would set them up on different days as well, just so that there isn't a potential taxation on the payout. So do read up on the Rice-Staff principle as well. So with gifts, a lot of you will probably know about gifts and things like that. So a gift happens if somebody gifts money to someone and they die within 7 years of that happening. Now, the problem that we have with this is that this isn't even necessarily in a high net worth space. This can also just be parents giving deposits to children to help them towards buying a home with £30,000. Here you go, help you set up on a property ladder and things like that. That is a gift, because anything above £3,000 is seen as a gift if it's done in a year. There's sometimes an allowance for 6,000 if we've not done a gift the previous year, but again, it's a little bit tricky. But we just need to be, if you're an advisor and you hear that someone's received some money, it's over £3,000, you might just need to do a little bit more digging. Just make them aware at least that there could be some gift taxation there. And helpfully, we've lost a lot of the specific gift insurance policies that are available in the industry, so we'll just chat about them a little bit. It's really important as well. So with inheritance tax, if it's a single person, obviously the inheritance can come from one person. If it's a married couple, it could be coming from two people. With a gift, a lot of people say to, oh, well, my parents gave me a gift. That's fine, but when it comes to a gift does actually come from one person. So when we're doing a policy, it is a person that we are insuring. We wouldn't be doing joint, we'll be doing as first, because we need it to pay out when that person dies. So it'd be the first person death. So gift, the insurance will be, the tax, sorry, will be over 7 years. And we used to have a wonderfully termed policy called gift Inter Vivos, which was a really specific life insurance policy that would taper over time, because with the gift taxation, it does reduce over time, which is quite nice. But we don't really have them anymore. There's only LV that still have a gift Inter Vivos policy, which can be brilliant in the sense of it has specific rules in there as well that potentially offers some additional protections if the government decides to change like gift percentages and things like that. But ultimately, the problem can be is that if LV aren't able to insure because of risk, health risk, or maybe they're rating it significantly, it's been really, really pricey. We might decide, well, actually, instead of using a gifts Inter Vivos policy, we might just do a little bit of fancy work as an advisor. So what you would do is you would figure out what the gift is, and we'd choose 40% of that. We're just going to get 40% of it. We're then going to divide that by 5. So we're going to have 20% of the overall 40%, okay? And we're going to insure one of those 20% for 7 years. And then we're going to insure them for 6 years, for 5 years, for 4 years, for 3 years. So it's going to taper over time. It is faffy from an advisor point of view. Shouldn't be something that really the client should be too bothered about. Should be able to hide sort of like a lot of it from them in a sense of a lot of the procedural things, not hiding the advice or anything like that, but just like the faffiness that we're going to be doing. And we're going to get that obviously in front of them so that they can make a decision as to what they want to go with. I say ideally we would be doing the proper gift Inter Vivos, but there's other ways that we can do it. We can do those 5 individual policies. With some insurers, we can get multi-plan discounts, which are nice. Granted, it's going to mean, in a sense, pounds worth of difference, considering what would usually be quite a high premium, depending upon the gifting that's taking place. But just be really, really mindful of it. And as well, when we're talking about things like consumer duty and all these kinds of things, even if it's not your thing to be talking about IHT, to be talking about gifting, if you hear about something, you start thinking, hang on a minute, that's there, or if they said that, you should really be checking on it. And if need be, suggesting that they, again, bring in an IFA or bring in a protection insurance advisor if you don't do that insurance side of things, just so that we can make sure that at least that conversation's happened and everything's done, everyone's done everything possible. Smart person. So with the gift trusts, so this is the one where we definitely say, so this is the one that we need to really be careful about the spouses and automatic beneficiaries and things like that. We do not want the spouse to be getting this at all, because, it's just going to, the person who has then received the gift, which is, say, usually a child, will then need to probably borrow the claim from the parent who's just received the money to pay off the taxation, which then in itself is going to create another gift. So we just need to be really, really on top of it. And again, we have to be gifting that terminal illness benefit, because we need the money to be going to who we want it to be going towards. So the kind of like the last thing that we're going to be broaching on ever so slightly, I do appreciate we've got probably about 15 minutes left once I've finished wittering about this, but it depends on how much I witter about this. If you have any questions, any thoughts, I know Lee might be coming in and chatting about his knowledge and his experience as well of doing this when he was doing a lot of advice in this area. But the last one for us to chat about is potentially business property relief. Now, there are certain allowances that the government allows people. So with business property relief, it's all about, and it really came from family businesses, because what the government were finding is in terms of inheritance tax planning and things like that, and the inheritance taxations, is that ages ago, there was families who had family businesses, they would then inherit the business, but then they'd be taxed on the value of the business, which often meant that they were having to close the business, sell it, anything like that to try and make the tax. And then that was obviously having a big knock-on effect in terms of that family, in terms of the community, in terms of people being employed, just generally getting money into the economy and things like that. So what the government allowed was sort of a certain kind of relief to be done if somebody is to buy, in a sense, or acquire shares in a company. Now, this is talking about companies that aren't on the stock exchange. There are a few other types as well, but generally your big companies, don't worry about it in a sense, but we are talking, again, lots of family businesses, small SMEs. Potentially, we've got quite a few IFAs here. You might be selling a practice, you might have bought a practice, things like that. And what we're doing is with the business property relief, if somebody has bought shares in a company, there can be a tax on those shares. Now, it's different because they're going to bring in, usually I always think of like taxation, in a sense, IHT there's no end time frame. Gift, 7 years. With business property relief, it's 2 years. So we don't need to do a massively huge policy at all. I've done a podcast on this recently, and I did some examples of pricing in there. So please do listen. It can be incredibly low, the amount of money that it is. But essentially what you do is you insure against the person who's bought the shares. If they die in the first 2 years, then they can be taxed. So what we're just going to do is say, right, well, if they do die, we're going to insure against the tax liability for the next 2 years. Done and dusted. It's something that's quite easily done. There are quite a lot of caveats in terms of which businesses can get the relief, which ones can't, how much relief they can get and things like that. So it is something, it's not something we all come across on a day-to-day basis. So do obviously have a look online. You know, I've written things about it on the Cura website. There's a podcast as well. The other thing I would say, I know I mentioned obviously Andy Woolen from Zurich before. There's lots of insurers, Royal London, Legal and General. If you put in the insurer name and the product type, you will find that there's usually really, really good details on their websites about what they mean. And the other thing as well, because again, a lot of this is to do with taxation. If you get in touch with your account manager at the insurers, they are brilliant at getting like access to the tax people. And you'll find that tax people are actually, because they don't often get a chance to speak to advisors, they're often really, really happy and eager to have a chat and sort of go, oh, so what are you wanting to know? And then they'll just tell you everything. They'll sometimes come and do presentations for you and your team to be able to explain it all. So if it is an area that you start to experience a bit more, it can be worth reaching out to the insurers and really tapping into that knowledge, because that, you know, we can't all know everything about everything. And, you know, it's quite I think an important thing as an advisor to sort of say at times, you know what, I'm really, really good at doing all this, but you know, the actual taxation laws surrounding this kind of tax and the way that I will be doing insurance for it and not at the top of my mind, you know, in a sense of what my key knowledge is. So it's always worth just reaching out, having that kind of thing. And this, in terms of the business property relief, it might not be something you've come across, but it's sometimes because we've not necessarily asked the right questions. You've got to think about 80% of businesses in the UK are SMEs. And there's a lot of people who are inheriting or buying into or exchanging businesses. So there's only 20% really of the businesses in the UK that probably wouldn't be in line for having this business property relief side of things on it. So it's something that we can identify. It gives an extra bit of support to that client. They might not even know that that taxation is going to be there potentially. So it's something that we can do, and it really sort of like puts us in good stead with clients if we are identifying those kinds of things. So that's me having spoken through quite a lot there. Thank you everybody for listening to that and bearing with me. Lee, any thoughts, any questions? Anybody else have any questions? Please do feel free to put them into the chat.
Yeah, thanks, Catherine. Crikey, we cracked through a lot there. That's fantastic. So a couple of things from me. One, I would definitely commend the Practical Protection podcast. It's such a great resource and series, and we're very happy on Octo to be supporting that. So do check that out if you haven't already, and I'm sure many of you have. A quick question, Catherine, as sort of, I don't know, as co-host's privilege, I guess. You talked about gift Inter Vivos and only being one real provider left. Is this because we've seen the demise of so many insurance companies, and so many have merged or have turned themselves into investment platforms or whatever they happen to have done? Are you finding that there's less and less opportunity to insure, or are they being replaced by newer providers?
It's a bit of a strange one, really. So not every insurer does joint life second death term assurance, so not all of them will do the to age 91. So obviously, if you don't have that on your panel, then you maybe need to reach out, or should really reach out to someone who can. The gift Inter Vivos, we had LV and Aegon, and obviously Aegon went, so now we are just down to LV, which is a shame. But I think with insurers, I wonder if it's more to do with where the commerciality of things are, to be honest. So we're finding, as I'm sure a lot of advisors here are seeing, you know, endless amounts of options for critical illness cover and income protection, which is brilliant because they are so adaptable to so many client situations. And we really do want to see that. But it does seem like, well, if we're not having many people doing the gift Inter Vivos side of things, it just, you know, there's not that, I imagine there's not that kind of draw to be doing that because of the fact that, you know, some people are just quite happy to absorb the gift and just assume that it's going to be okay. I think with a lot of people, they do rely on advisors to be speaking to people, to be saying, this needs to be done, you need to do the gift Inter Vivos policy, rather than it being people going to the insurer and saying, oh, I think I need to insure my gift. So it is kind of, I think, to be on the advisor community, to be chatting about it more. I do speak to quite a few IFAs where I'm saying to them, oh, well, when they say, well, what can you do to help our clients? And I'll say, then I'll say, I can do gift Inter Vivos type policies. And they'll go, oh, I didn't realise, and there often seems to be quite a bit surprised that they're still available or that there are ways of doing it. So it's making sure that advisors know that it is there. It should be a discussion that is happening. And then, but also, unfortunately, with the insurers, until we start getting that push back to the insurers and that appetite to them of we are wanting this, they're probably not going to spend time and dedicate resources to building the product in their systems.
Yeah, great. Thank you. So Tracy has raised her hand. Thanks, Tracy. Feel free to come on screen or put it in the chat, however you'd like to do it. Hand is up, but no response. Perhaps it's
I'm wondering, maybe it's a phantom hand. Maybe we didn't mean to do the hand.
Phantom hand. Okay, not to worry. A phantom hand. Any other questions? I mean, the other thing, I guess, I should have probably been a little bit clearer. I've not given advice for 5 years now, so I'm rather behind the curve, and it's many, many years since I did my G10. But I guess something we should talk about briefly, Catherine, you touched on it, is as we wander towards the close, is signposting. That specialist stuff that you do.
Yeah, absolutely. So I mean, there's a lot of firms that you can signpost to. So obviously, I'm protection insurance. A lot of IFAs come to me to do the protection side of things for a number of reasons. One, either well, to be honest, the majority of the time it's a case of that they just don't want to do it. They're much more happy doing investments and pensions, can't be bothered with protection, and very happy for me to step in and do it. It can be because there's a risk there and they're just not sure what to do in terms of a health condition. It might be that that they're part of a network and they have a limited panel, so they can't access some of the things that we can do. So you obviously do have the signposting in that kind of an area where you can come to people like me. If you are part of a network, we do support quite a lot of networks in the UK, so maybe ask your network, because some networks do have other firms that they suggest, so check who your network says that you should be speaking with to provide the support. You also do have, depending on what you want to do, you do have Bieber's Find a Broker service, where you can go on to, if you do search on Google for Bieber Find a Broker, lots of specialists on there, all the firms on there have been vetted. I do sit on the oversight committee, so if you do contact anyone on there and they sort of like they don't have the specialism that they say that they're having, do update me and let me know so that I can feed back to people on that. But I think a really key thing with signposting is, and I think a lot of IFAs get this, majority of IFAs I think do, is the fact that it isn't a weakness. It's not saying I'm not good enough. Just like if you have a solicitor, they will say, right, I'm your solicitor, I'll do the law stuff, but you need an accountant to do the maths. That's exactly the same with this kind of thing. There's, you can't, I find it I think it'd be very, very difficult. And I think an incredibly skilled person who could do everything, pensions, investments, mortgages, private medical insurance, protection, to the top level in all areas, because there is just so much to do. I would love to be a full financial advisor. I'd love to do investments and pensions. I literally don't have time. I'm doing protection insurance through and through. It is so technical. There are so many ways it can go wrong, especially with trusts and things like that. So, we just really, really want to sort of like make sure that people know, like, just reach out to each other, set up a nice network. You might say to someone, look, I'll bring you the gifts, the people for gifts and IHT. You bring me people to do mortgages. Can we make that work between us? Can we really, really positive? Quite a lot of people make quite a lot of success, with estate agents in the local area, with solicitors, accountants, referrals coming in. It's no different to speaking to a protection specialist. If you find that you're in an area that you can't do, I had somebody where I was providing support, significant IHT liability in the UK, but they lived in Europe and they were European citizens. So obviously we needed to go to international routes. So you might not have international insurances. If you do want to sort of like have a look at international insurance, what's really important is that you do double check with your PI insurer. that you are allowed to do those. Obviously, you need to get agencies, but there are also some UK insurers now that are changing their structure a bit, sort of like becoming what's known as non-admitted policies, which again, just double check if there's been any changes in any of the insurers, just because again, you would need specific PI insurer permission to be able to offer those. And you don't end up in any hot water by not realizing there's been a change.
Great, thank you. So from Katie Davis, she says, thank you. But her question is, do you always suggest seeking advice from a qualified accountant or tax advisor to verify the liability on estates to strengthen your file and advice? She has a few clients who've come to her with self-calculated liabilities and usually draft in another professional to help quantify this. Is that something you would support?
Yeah, I usually suggest that they should have an IFA to make sure, because again, it might be that we look at it from a protection advisor point of view and think, right, they need £400,000 worth of whole of life. But an IFA might come in and actually go, do you know what? You don't, because when I've done this calculation over here and actually with this allowance of it, and it gets really complicated. We have had it though before, because obviously we've all had it. We've had insistent clients. And, certainly had it where we had an insistent client who was very much a case of like, no, I've calculated it and it needs to be this, and I want this, and stuff like that. And then you have that kind of thing like, well, do I support this person and know that I'm doing it right and what they're going to get is right? Or do I leave them to, because, they've been so insistent, they're just going to go somewhere else and someone might do it wrong. And then I'm going to feel, potentially responsible. But anyway, so I think as long as, like with that situation, we were very clear to the person and said, you should speak to a financial advisor. This is a financial advisor that we trust, that we would like you to speak to. If you are choosing not to speak to them, we can't force you to speak to a financial advisor. We can't force you to pay that fee, but we are going to write in our report to you and have it documented everywhere that we have told you that you need to speak to a financial advisor. And based upon what you've told us, this would be, in a sense, the liability that you would be facing. However, we're not financial advisors. We cannot confirm that we have met the full IHT liability. So it's just making sure that you protect yourself, because, ultimately, we can't force people to do things they don't want to do. But at the same point, you then have to make a decision for you and your compliance as well as to whether or not there are times that you will just walk away. There's times that we've walked away from them and said, even though business-wise, commercial decision, really bad commercial decision to walk away from someone in that certain situations, but you can just think, you know what, I'm really not okay about this. We also had something once where you do need to be careful about safeguarding, quite specifically in vulnerability. We had one once where there was a family, and due to the family and their background, their culture, it would have been a male child that would have received all the estate. So they wanted to put insurance in place so that the female children could receive some funds as well, which was obviously a really lovely thing to do, because obviously based on their culture, that's the way it would work. But then you also need to stand your ground. So at that point in the trust, they wanted the trust to be all set up for the male child, because again, they would be the one who would sort out the finances. So for us, in our point of view, in that situation, from a safeguarding point of view, we insisted that actually the females were also included in the trust as trustees as well, because we just felt there are certain times when some things will come up where you just think, you know what, actually, we're going to be doing this. I respect people's decisions and things like that, but we feel that this needs to be done in this way, just to make sure that everything's going how we want it to go. I hope that's helpful.
That's really helpful. Thank you. So I'm just doing a final check because we're coming towards the close. Just doing a final check for any final questions, no hands up or anything. So I think we're gonna be crashing out just on time, Catherine. So final call for questions. If not, sorry, Catherine,
One question has just come in terms of seeing the deed of gift of cover.
Oh yeah.
I wouldn't necessarily say that's a be all and end all for doing the policy, because ultimately, if the gift's there, the gift is there. Not everybody does gifts by deeds either. A lot of people won't do, as I say, just giving money to family members. They just won't even realise that that is a gift, and they won't have done it officially through a solicitor. If there is a solicitor involved, then yes, it's lovely to see it. But a lot of the time, it just simply won't be there. So you would just go ahead with what has been explained to you right there and then. But yeah, that's fine. So yeah, I think we're at the end, Lee.
Brilliant. Thank you. Thanks to everyone for your questions. Thanks for your attendance. Of course, thanks to Catherine for all her experience. And we really look forward to seeing you at the next one. And feel free to drop anything through in between sessions as well to Catherine, or follow up on any questions that you didn't manage to ask today. But thanks again for your attendance. Thanks, Catherine.
Thank you, everybody. And I'll put the CPD certificate up on the Advice of Advisors website later today. So please do go on there and get your CPD certificate.
Thank you.
Fantastic. Thank you, everybody.
Thanks
Bye.
all.